Hi, good
Good
evening,
evening,
everyone.
everyone.
Thank you
Thank
for
you for
joining me
joining
in
me
this
in this
session.
session.
So,
So,
in this
in this
session, we're
session,
going to
we're
be
going to be
talking
talking
about
about
IFRS
IFRS
23
23
and we're
and
going
we're
to be
going to be
talking
talking
about
about
how it
how
has
it has
created a
created a
challenge
challenge
for
for
us
us
as a
as a
financial
financial
analyst,
analyst,
as a
as a
financial
financial
modeler when
modeler
it
when
comes
it
to
comes to
forecasting.
forecasting.
So, a
So, a
lot of
lot of
things in
things in
accounting
accounting
has
has
been
been
done with
done
good
with good
intentions,
intentions,
but that
but that
doesn't
doesn't
mean
mean
that it
that
has
it has
always
always
had
had
good
good
impact.
impact.
In my
In my
view,
view,
IFRS
IFRS
23,
23,
I'm
I'm
sorry,
sorry,
IFRS
IFRS
16, in
16,
my
in my
view,
view,
is
is
one
one
on
on
that
that
line.
line.
So,
So,
IFRS
IFRS
16, which
16,
is
which
on
is on
lease
lease
accounting,
accounting,
is
is
something
something
that
that
probably
probably
was
was
brought with
brought with
good
good
intention,
intention,
but
but
has
has
thrown a
thrown
lot
a
of
lot of
challenges to
challenges to
us,
us,
which
which
probably
probably
many are
many are
still
still
not
not
aware.
aware.
But
But
only when
only
you
when you
start
start
analyzing,
analyzing,
you will
you will
probably get
probably
to
get to
know it.
know it.
Before I
Before
take
I
you
take you
through
through
that,
that,
let me
let me
first
first
start
start
with
with
some
some
introduction
introduction
on
on
why
why
lease
lease
accounting
accounting
itself, lease
lease
itself,
itself
creates
creates
challenge for
challenge for
financial
financial
analysis,
analysis,
and
and
what
what
IFRS
IFRS
16
16
in
in
India,
India,
the
the
same is
same is
recommended through
recommended through
IndAS
India
is
is
116.
116.
What does
What does
it
it
mandate for
mandate
us to
for us to
use?
use?
We'll
We'll
talk
talk
about
about
that
that
briefly.
briefly.
Then I'll
Then
talk
I'll talk
about
about
what
what
challenges it
challenges it
creates.
creates.
So to
So to
start with,
start with,
let
let
me
me
let me
let me
take us
take us
back
back
just
just
one
one
moment.
moment.
So
So
let me
let me
start with
start
this
with this
IFRS
IFRS
16.
16.
So when
So
you
when you
talk
talk
about
about
IFRS
IFRS
16,
16,
but
but
before, I
before,
mean,
I mean,
as I
as I
said,
said,
before
before
getting into
getting to
IFRS
IFRS
16,
16,
first
first
let's
let's
talk
talk
about
about
what
what
challenges
challenges
that
that
lease
lease
create.
create.
Let's
Let's
talk
talk
about,
about,
let's say
let's
there
say
are
there
two
are two
companies,
companies,
All
All
Own
On
Co.
Co.
and
and
Me
Me
Rent It
Rented
Limited.
Limited.
Now,
Now,
All
All
Own
On
Co.
Co.
owns
owns
all its
all its
assets,
assets,
and let's
and
say
let's say
it's
it's
purchased an
purchased an
asset for
asset for
60
60
million
million
currency,
currency,
whatever
whatever
that
that
currency
currency
is.
is.
And
And
this is a
this is a
long-term
long-term
asset which
asset
is
which is
expected to
expected to
last for
last for
100
100
years.
years.
Now,
Now,
they've
they've
funded
funded
this with
this with
60%
60%
debt,
debt,
and
and
this
this
debt
debt
was
was
borrowed
borrowed
at
at
8%
8%
for a
for a
period of
period of
5
5
years.
years.
This is
This
going to
is
have
going
an
to have an
annuity of
annuity of
around
around
9.02
9.02
million.
million.
On the
On
other
the other
hand, Me
hand, Me
Rent It
Rented
has
has
not
not
purchased
purchased
it,
it,
has
has
taken the
taken the
same
same
premises or
premises or
similar
similar
premises
premises
on
on
rent,
rent,
where the
where the
annual
annual
rent is
rent is
currently
currently
1.2
1.2
million,
million,
which is
which is
likely to
likely to
increase at
increase at
3%
3%
per
per
annum.
annum.
And the
And the
lease
lease
term is
term
going
is
to be
going to be
4%.
4%.
Sorry,
Sorry,
4
4
years.
years.
Applicable
Applicable
rental
rental
yield is
yield is
around
around
2%.
2%.
Now,
Now,
when you
when you
look
look
at
at
compare the
compare the
financials of
financials
the
of
two
the two
companies,
companies,
because
because
All
All
On
On
Co
Co
owns the
owns the
asset
asset
at the
at the
beginning,
beginning,
11
11
asset to the
asset to
tune
the
of
tune of
60
60
million.
million.
It's
It's
taken
taken
debt
debt
to the
to
tune
the
of
tune of
60
60
percentage,
percentage,
which
which
means
means
it is
it
going
is
to
going to
have
have
$36
$36
million
million
of
of
loans,
loans,
and it
and
would
it would
also
also
have
have
around,
around,
because of
because of
this,
this,
it's
it's
going to
going to
have
have
interest
interest
obligation
obligation
because it
because it
has
has
debt
debt
and
and
therefore it
therefore
has
it
to
has
pay
to pay
interest.
interest.
And
And
there is
there
going
is
to be
going to be
depreciation
depreciation
because
because
it
it
owns the
owns the
asset
asset
and the
and the
asset is
asset
on
is
the
on the
balance
balance
sheet.
sheet.
So if you
So if you
look at
look at
it,
it,
All
All
On Co
On Co
with
with
interest and
interest and
depreciation will
depreciation
be
will be
reporting
reporting
3.5
3.5
million
million
of
of
expenses.
expenses.
Rented,
Rented,
on the
on the
other
other
hand,
hand,
does not
does
have
not have
any
any
asset,
asset,
no
no
debt,
debt,
no
no
interest,
interest,
no
no
depreciation.
depreciation.
It
It
has
has
1.2
1.2
million of
million of
rental
rental
expenses.
expenses.
This is
This is
how
how
we would
we
have
would have
shown it
shown it
under
under
IAS
IAS
7, which
7,
is the
which is the
old
old
accounting
accounting
standards for
standards for
lease.
lease.
Sorry,
Sorry,
IAS
IAS
17.
17.
Now,
Now,
because of
because of
this
this
different
different
way
way
to
to
use
use
the
the
asset,
asset,
it
it
becomes
becomes
difficult to
difficult to
compare
compare
performance of
performance of
All
All
On
On
Co
Co
with
with
Me
Me
Rent It,
Rented,
because the
because the
expenditure for
expenditure
Me
for Me
Rent It
Rented
is
is
much
much
lower
lower
compared to
compared to
expenditure for
expenditure for
All On
All On
Co
Co
in
in
the
the
first
first
year,
year,
and
and
All On
All
Co
On Co
has
has
more
more
assets
assets
and
and
more
more
debt.
debt.
Me Rent
Me
It
Rented
doesn't
doesn't
have
have
any
any
such thing.
such thing.
So
So
it
it
becomes
becomes
difficult for
difficult
us
for
when
us
we
when we
have to
have to
compare, let's
compare,
say,
let's say,
efficiency, who
efficiency,
is
who is
utilizing
utilizing
their
the
asset
asset
better.
better.
Because Me
Because Me
Rent It
Rented
doesn't have
doesn't
the
have the
asset in the
asset in the
books, it
books, it
becomes
becomes
difficult.
difficult.
So
So
what
what
choices could
choices
have
could
been
have been
used? used. One choice that exists is probably to capitalize the rental expenses. So if I was spending 1.2 million, if I was paying 1.2 million in rent, we know the rental yield is 2%. Maybe I could have created a asset. I could have created an adjustment as an analyst. I could have said, you know what, if 1.2 is the rent and if rental yield is 2%, I'll create an asset of 60 million, which will be there in my adjusted financial statement. But this was not always easy, or this was not always good. It had its own challenges. What is it? See, the actual asset which Alon co-owns it would be accounted under historical cost method, which means each year we'll be reducing the depreciation. So, and the depreciation will be 0.6. So if you look at it over a period of time, this number would keep going down. I mean, the value of the asset would keep going down. On the other hand, here main entity has agreed for a 3% rental escalation. So the rent would be increasing at 3% per annum. And if you assume that the rental yield remain constant, we would see that the rental yield would have created an asset of now our asset because of the rental yield, our asset balance is increasing. So as my rental expenses increase, the capitalized value of asset would increase. This would be completely in contrast with what the company reports. So this analyst adjustment was not always easy to carry out. In the first year, it looked like it made sense. Subsequently, we are not able to come up with an apple-to-apple comparison. So IFRS 16 came up with a solution, and the solution is, how do we deal with this particular problem? For that, IFRS 16 had a slightly different solution, and this solution was to capitalize the lease rentals. So let us say if I'm going to pay lease rent of 500 over a period of 5 years, and let us say my borrowing cost is around 8%. And in that case, what is going to happen is, we are going to capitalize this lease. See, that old IAS 17, I would have shown 500 as expenditure for every year for 5 years. Now, what we're going to do is, we're going to capitalize it. How do we capitalize it? Using time value of money concept. So we would create a right of use asset, where we calculate the capitalized value using this formula. Thankfully in Excel, I could use a PV function if the rentals are constant. If the rentals are constant, I could simply use a PV function to get the capitalized value. So what I'm going to do is, at the beginning of the year, I'll create an asset for beginning of the lease term, I'll create an asset for 1996. And I'll also create a liability to the same extent. Now this asset will be depreciated, because the life of the asset is 5 years, will depreciate it equally over a 5-year period. So 1996 divided by 5, which is our lease term, we divided that rate, and our closing balance becomes 1996 minus 399. Now next year this becomes my opening balance, and I'm going to have the same depreciation. So each year I'm going to depreciate this 1996 over a period of 5 years. Now when it comes to liability, what's going to happen is, we get a liability of 1996. Keep in mind, this was credited taking into consideration an 8% borrowing cost. So we calculate interest at the rate of 8%, opening balance times 8%, and then reduce the, and whatever lease amount we pay, we're going to treat as though it is an EMI. You reduce that, and we get a closing balance of debt. Next year, we'll show 8% interest on the 1656. And what would go to our P&L as expense? That would be depreciation plus the interest. So this is how we are going to spend, or rather account for leases going forward under IFRS 16 or IndAS 116. So this, many believe, that creates a fat treatment of lease, because as compared to owning an asset, when you take an asset on lease, there is no depreciation, there is no interest, or there was no depreciation and there was no interest. Whereas this accounting methodology has brought down the two. Right? This we believe is a fat treatment, or many believe is a fat treatment. Now, why I am not happy with this, or what are the challenges it creates for me as an analyst when I am trying to model this? Now, first and foremost, if the asset is for 100 years, let's say I have taken a building on rent, is this the fair value of the payment that I'm going to make? Is this the fair value of the asset actually? So is it satisfying my requirement of creating an apple-to-apple comparison? No, because this asset's actual value will be much higher. That would be taken into consideration its entire life. But I have signed a lease only for 5 years, and I'm showing only for the 5 years. So it doesn't satisfy my requirement for creating an apple-to-apple comparison. Now, IFRS 16 does not state that as its objective. IFRS 16 says it wants to have a proper representation of the lease obligation, right? A faithful representation. That's the term IFRS 16 in its objective statement uses. They want a faithful representation of the lease obligation and help investors understand the future cash flows that are underlying the lease. So according to it, this is a faithful representation because you've signed a commitment. You've signed a commitment to take a lease for 5 years, and therefore you have to create an obligation to the tune of the amount payable over a period of 5 years. Now, what challenges does it create for me? Think of it. If you're talking about a going concern, if they have signed a 5-year lease, wouldn't they be renewing it at the end of 5 years? Either the same property or some other property, right? Eventually, I need to have, if I'm a going concern, I need a property. So if the lease term ends, I need to reopen or I have to renew a new lease. Now let's talk about how this renewal, how this accounting treatment creates chaos when it comes to forecasting cash flow, especially taking renewal into consideration. For that, I am now going to give you an illustration here. This illustration is already done. I have created it using dynamic array, but I'll redo this entire thing with traditional relative referencing model so that most of you can relate to it, understand it. These calculations here with dynamic array for a lot of you would look like Greek and Latin. So I'll not take you through this, but let's look at the numbers here. What I'm going to assume here is, let's say I have a property that's worth 200 million and the life of the asset is 20 years with the cost of capital being 8%. Now, how do we charge the rent? See, the rental can be a level rent, which means I could assume that we'll be charging same rent all through the year, all through the life of the asset, right? So here I could say, we'll charge same rent across the life of the asset. But most of the time, we are going to come up with an inflation clause. So what I'm assuming is that the rentals will be increased by 5% per annum. So if the rental is going to be increasing by 5% per annum, now mathematically, if the lessor were to set the rent such that the present value of all future rentals helps them recover this 200 million, the first year rental will be kept at 14 million. 13.9 to be precise, and each year this would increase by 5%. Now the idea is if you sign for a full 20-year lease, you will be having this 13.9 growing at 5% per annum. If it's a 2-year lease, for the first 2 years you'll be 13.9 and 14.6, and in the third year when you renew it, because obviously this lease has to be renewed. You are a going concern, you're going to continue. If I take that as an assumption, this lease has to be renewed. And I am assuming here that at the time of renewal, the escalation will be factored in the renewal clause as well. That is what I am assuming here, right? So let us see under the new accounting standard how things are going to work. So let me do the illustration here. Now, if I were to account for this under the old IAS 17, whether it is 2-year rental or 10-year lease, I would be showing same expenditure every year. This 20-year lease would have been a financial lease. For that, the accounting would have been based on the technique we saw earlier. It would have been on that basis. This is how we would have done that calculation for a 20-year lease. And that is okay because it's a 20-year lease. You are in any case covering the full asset. There is hardly any time left to renew the lease, right? Because you're going to use the asset for its entire life. There is never going to be, there is no concept of renewal there. Whereas these two, under IAS 17, we would have shown the same expenditure all through. But what does IFRS 16 suggest? So for the first 2 years lease, what I'll do is, I'll create an asset at 8%. I mean, I'm going to discount these two cash flows at 8% and I'll create an asset, which is 25.4. If I had signed a 10-year lease, I would, at the same 8%, I am going to now take the lease rental for the next 10 years. And I would show an asset at 140, which is much higher. For 20 years, this in any case, as I told you, would have been accounted as a financial lease in any case. So here I would have taken the full 20-year lease. Now, in the initial year, I would have taken a liability to the same extent, 140 and 200. Now, what would have been our depreciation? For a 2-year lease, you take this 25.4 divided by 2, right? And for the 10-year lease, I would be dividing this 114 by 10. And for the 20-year lease, I'm assuming a straight line method, I would be dividing this 200 by 10. So you can see here, The first lease rental is 12.7 and 11.4. For 20 years, it is 20 million. What would have been my interest? 25.4 times 8 percentage, 114 times 8 percentage, and 200 times 8 percentage. Okay, I've just been getting some inputs that there is a heavy echo. Let me just change the audio mode.
So hopefully the echo would not be there anymore. So maybe there is some problem with my headphones. So let me go back to what I was talking about. So for 2 years, it's 25.4, 10 years is 140, and 20 years is 200. This is the net present value we created, and it had a liability to the same extent. So the 2-year asset is getting depreciated for, I'm depreciating the ROU, right of use. ROU stands there for right of use. I will be depreciating it for 2 years. The 10-year lease, whatever the beginning value of asset, I'll depreciate it by 10 years. And the 20-year, I am depreciating it for, I'll be depreciating it by 20. Now, when it comes to my interest, whatever lease obligation I recognize at the beginning into the interest rate 8%, that's what I'm going to charge as my interest obligation. Now, if you look at my total expenditure, which is depreciation plus interest, for a 2-year lease, I'll be showing 14.8, and for a 10-year, I'm going to show 20.5, 11.4 plus 9.1. Why is interest very high for a 10-year lease? Because the liability value is higher. And for a 20-year lease, again, it's going to be even higher because the liability value is high. In the second year, what would happen? Having depreciated the asset by 2, I have depreciated this asset by 2, so therefore the opening balance would come down. This one would come down to the tune of 114 minus, I'll just reduce the depreciation amount. This would come down. And same thing will happen for my 20-year lease as well. My 20-year lease will come down by 10. What about our liability? As far as the liability is concerned, we start at 25.4. To that, you add the interest part. And at the beginning of the last year, you would have paid this 13.9. You reduce it. So the liability would be 13.5 for the second year. From 25.4, it comes down because the 13.9 lease rental we pay, we are showing it as though it is a principal repayment. I'll apply it for 10 years and 20 years as well. And depreciation is going to be it's going to be the same as what I got for the 2 years. It's going to be the same because it's straight line. And we've got the numbers here. Now in the second year, when I look at it, notice that I've got some numbers here. Right now, second year you don't see a big problem. Let's go to the third year. What's going to happen here when I go to the third year? When I go to the third year, I will have to, for this 2-year lease, this 2-year lease is going to get renewed again. So I have to create a new liability. So you can see here my liability is spiking from 12.7 because I'll renew my lease for another 2 years. Right? I'm assuming here that you will renew it 2 years at a time. My liability is spiking from 12.7 is jump asset is spiking from 12.7 to 30.1. And it's the same that's going to happen with my liability as well. There is a spike. The expenditure, depreciation is going to spike from 12.7 is going to 15.1. Why? Because these assets, when the rental increases, the present value increase because the rental is increasing, depreciation is spiking, and as far as our interests are concerned, the interest is also spiking. Right? So the third year, if you look at it, our total expenditure is spiking for a 2-year lease. The 10-year, you don't see it at all. In the 10-year, that's not what is happening because as far as the 10-year is concerned, we are going to be reducing it. I mean, we are not renewing it. It's the old calculation that's going on. Same thing applies for the 20-year as well. It's the old calculation that's going on. So I'll just expand the calculation. And if you notice, the 10-year lease expenditure is coming down over a period of time. The 20 years is also coming down over a period of time. The 2-year lease comes down every alternate year, but then spikes in the next year. If I kind of continue this entire calculation for another block of, let's say, till 10th year, right? I'm going to let me continue this till the block of 10th year. So you would notice here for 10 years, my 10-year lease rental expenses, total expenses coming down. 20-year has been gradually coming down, almost flat, but it's still coming down. And 2-year lease, what started at 14.8, in the 10th year, if you've been renewing it 2 years at a time, it's the same property. Keep in mind, it's the same property. I'm using it with myself. I'm paying the same rent. There is no change in the rent. The cash flows are same. But the accounting wise, the expenditure is much higher what I'm showing in the 10th year. Now, in the 10th year lease, what is going to happen is, because you'll be renewing it afresh in the 10th year, right? This lease would have expired in the 10th year. So you will have to renew it again in 11th year. And when you renew it in 11th year, at the same 8% cost of capital, now that with the inflation factored in, there's going to be a higher rent. When you capitalize, you see a massive spike again in your asset balance. And this massive spike would also mean you would see a massive spike in your liability, massive spike in your depreciation, and massive spike in depreciation, and massive spike in interest. Everything is going to increase. I have already created the full illustration here. For those of you who have already registered, I'll be sending the file. I'll not send the file with dynamic array because, as I said, this is a little too complicated calculations, which rather than us manually copying the block, it automatically does it on its own. It's going to be, for a lot of you are not exposed to this, it's going to be complicated to understand. So I'll send you one with the typical traditional relative representation based approach. But here I have the charts. You can see here what is happening. The green one is the 20-year expenditure. And you see here my lifetime expenses is gradually going down. Whereas the 10th year, look at it, if I took a 10-year lease and renewed it again at the end of 10th year, based on our calculation, it gradually comes down over a period of 10th year, and in the 11th year it spikes, and then again gradually comes down. Where is our expectation? I mean, we talked about, doing apple to apple comparison. Where is this question of apple to apple comparison? And look at the 2-year lease. A 2-year lease they keep renewing every second year. This lease is gradually increasing over a period of time. So in the initial year, when I took a 20-year lease, I got a much higher expenses. Whereas a 2-year lease, I'm going to renew at the end of every second year, I'll be showing a lower expense. And the later part, this 2-year lease that I'm renewing would be accumulated at a much higher lease expense. I'm talking about depreciation plus interest put together. And then the 20 years is going to come down gradually over a period of time. This creates a massive comparison problem for us, right? And as a forecaster, what is the problem for me, right? If I knew the lease terms, if you're going to disclose, if you're going to give me the entire lease term on what is the plan to renew it, I could still forecast this. But companies are not going to disclose this to me. What would the company disclose? Company would disclose what is the lease obligation, because that's what IndAS 116 or IFRS 16 expects them. It expects them to show how much of lease obligation is there for next few years. 1 year, what you have to pay between 1 and 3, about 3. I mean, by time slabs you give it, you give your cost of capital. Now, for me, even if I know this lease is expiring, do I know when you renew it, what is the term for which you're going to renew? Because if you renew it for 2 years, I'm going to have a different expenditure. And if you're going to renew it for 10 years, I'm going to have different expenditure. Different expenditure, different asset value, and different liability. And you can see the huge difference that we have here. It becomes extremely complicated to forecast this, because I have no idea how much of your leases are expiring. You have told The disclosure tells you how much is payable at each year. It doesn't tell you which lease is going to expire and which lease has to be renewed. And when you renew, what is the term for which you would renew? Without knowing that. In this example, I created this example, so I knew all the data. I mean, I made up the data, so I knew it. I could still forecast this. And this forecast is still ugly, right? It doesn't solve our problem. But IFRS 16 never claimed to solve this problem. IFRS 16 said it wants to create a faithful representation of your obligation and create visibility related to operating lease commitments. Did it create visibility to commitment? I don't think so, because without the data, I would not be anticipating the spike on this 10-year lease. Because when I look at a trend, if I am in the 10th year, I notice the data is coming down gradually. So I'll be expecting a further decline if I was not aware of this data. But when the company would report it next year, I would be surprised or I would be in for a shock, because the lease expenditure would have jumped big time, right? Now, this is for the total expenditure. If you look at the interest expenditure, this is how the three would go. This actually reminds me of the Gobman video game I used to play in my childhood. So the 2 years the interest comes down, goes up, comes down. Because why is it coming up, coming down every year? Because every 2 years you create a new obligation, and that obligation gets repaid, and which means the interest comes down. So next time you again create an obligation, this goes up. So this is how it's going to be. Whereas the 10-year, the interest obligation gradually comes down, spikes up, and then in the last leg it matches to the 20 years. In the 20 years, on the other hand, it gradually comes down over a period of time. This is how your numbers look like. Depreciation, again, we can see here. Because the 2-year lease, you're going to renew it, and every time you renew, you'll be renewing a higher rent, and you will be creating a present value based on, at that point in time, the value of the asset, right of use will be increasing, because in the 19th year, obviously, you're paying much higher rent. So the 19th and 20th year rent, when you discount it for 2 years, the value will be high, and this is what would be depreciating. The 20-year lease which you took, your depreciation is going to be flat, and then the 10-year which we renew, you will see a sudden spike in the 11th year. This is how that's going to look like. Now, before I wrap up this part, I want to talk about one thing, which is, would it really be this visible in case of a company, a real company? In a real company, at the end of the day, they would have only one asset. Correct? It's too juvenile or too simplistic to assume that they would only have one asset and all of them would have started the lease term at the same point in time. That would not have been the case. They'll have many lease assets. Some lease term would have started 5 years ago and they would be continuing. Some of them would have started 3 years ago and they would be continuing. Some of them would have started 10 years ago and they are due for renewal now. Right? You would have a variety of assets. Now, let me have here. So what I have here is, let us say, I have a company that started lease long time ago. Some of the lease was started 20 years ago, and they are their 20th year, and some of them are started 17 years ago, and some of them are started just right now. Now the company adopts different leasing practices. One is go for a financial lease for 20 years. Another one will go for a long-term lease, not a financial lease, but renew it, go for a slightly longer term or a medium-term lease and renew it. And then another one who goes for a fairly short-term lease which they plan to renew. Now, if you look at it, what I am doing is, I have pulled out the expenditures from this list. I have pulled out the data, because in the first year, if it's a 2-year lease, you will be recording a total expense of 14.8, of which depreciation will be 12.7 and interest will be 2. On a 5-year asset, you will be showing a 17.9 as a total expense, and 15.5 would be out of that would be the depreciation. So on that basis, I have created this here. And here what you notice is, when you look at all these 5 assets together, which are a mix of new leases and old leases, the summation of the total expenses is more or less comparable. So the problem is really not there. Right? It's not a very big problem. Whether you take a 10-year lease and renew it, or whether you take a 20-year lease, which is a financial lease, or 2 years and keep renewing, the total expense remains more or less fine here. 146, 133. That's less than 10% gap between them. It's not as bad as for the individual asset that we saw, which was crazy, right? Whereas 12.6 and whereas 33.2. That's almost two and a half times. Whereas here we don't see that problem. But having said that, while you don't see it in the total expense side, you will still see that in the depreciation. See, at the end of the day, one thing I tell you, one thing I explain is if you have an asset that's spread across full 20 years, across full 20 years, if you measure the total expense, that total expense will be same irrespective of what practice you follow. Short-term leases keep rolling it over, or medium-term leases and roll it over, or one big 20-year lease. But having said that, your interest and your principal part or depreciation would not be same. The summation of the two would be same. But how much you attribute to interest and how much you attribute to depreciation would be different. And that means what's going to happen? Your EBITDA margin analysis, your EBIT margin analysis, all of them are going to go for a toss. EBIT margin may still be fine because depreciation plus interest put together is overall fine. But when you're doing an EBITDA margin, EBIT margin will still be a problem. PBT margin will not be a problem, but EBIT margin and EBITDA margin is going to be a problem. You won't be able to do an apple-to-apple comparison at all. So these are going to be challenges that we're going to face. Now, what do I recommend? I'll wrap up in a couple of minutes, but essentially, what do I recommend? My recommendation is, or what do I do? Let me not call it as a recommendation. What do I do? As far as I am concerned, I would like to pretend as though IFRS 16 or IndAS 116 does not exist. Especially for companies which are taking over leases. But the new standard has also made it difficult for me to take that preparation because I was always happy with the treatment for financial lease because you do own it for the full term. There is no question of renewal of lease there. So creating this asset and liability was making sense. Now with the new, the illustration that I showed you here. Right now what we have done is we have removed the distinction for asset and financial lease and operating lease. We have one right of use. Now if all of them were operating lease, what I would do? I would do one thing that remove right of use asset from asset section, remove lease obligation from liability, reduce depreciation on ROU from depreciation, reduce interest on lease from interest, and show lease payment as rent. This is an adjustment and basically we are inverting all those recommended by IFRS 16. We are inversing all of them. But this is something I can do if all the leases are operating leases. But unfortunately that distinction has been removed now. Now we only get to see leases and right of use asset, and some of the leases will be financing leases. And for me, even this reverse engineering the financial statement now becomes difficult because I cannot segregate between operating lease and financial lease. Thankfully for us, companies do report. Actually this year they have reported. This year they have reported what if IFRS 16 did not exist. How would their financials be? They have reported it. So for this year, I am fine. I really don't have answer about how to handle this next year. And IFRS 16 has created this challenge, and as you can see here, different debt lease practices is going to throw us with different expenditure the expenditure path and forecasting, in my view, is a nightmare. I still haven't, probably over a period of time, I may be able to figure out something, but as of now, when I look at forecasting a company's lease obligation, I find it as a big nightmare. Alright. I think there was some echo issue. I am sorry. I hope you were able to at least listen to the later part properly. I don't see any questions here. So thank you for attending the session. And hope the second part at least you found it useful. If possible, I'll try to create a clean version and upload it to YouTube so that you can watch it once more. Thank you.